Welcome to the BS and Barron's Report for the week of March 19th, 2012. I'm your host, Craig Slayen. Each week we review the number one most respected weekly publication in the financial industry, Barron's Magazine, and profile the most noteworthy illusions they're publishing. We're going to go through the articles and advertisements in this issue of Barron's Magazine from exactly 1 year ago today to gain a perspective on how the following 5 industry illusions can kill your portfolio performance. So let's get started with the BS. Illusion number 1, our research works. Here Barron's is profiling Kevin Holt. Let's see how well his research worked in picking winning stocks. Mr. Holt manages the Invesco Van Kampen Stock Fund, an $8.6 billion mutual fund. Invesco charges a management fee of 0.86%, so he is bringing in fees of $74 million a year. This figure does not even include the fact that this fund takes 5.5% off the top of each new investor's investment with its front-load fee. So with the ability to spend $74 million, you would think that these guys could have afforded the best and the brightest to research and pick stocks for them. So how have they done? Let's look at their top 10 holdings. 7 out of the 10 did not beat the markets over the 12 months, with Bank of New York down 15%, Halliburton being down 23%, and Bank of America down 31%. Well, I guess our patience wasn't rewarded for this research. So let's now look at illusion number 2. Stock picking works. Barron's writes, there is safety in these numbers. In a crisis-ridden world, these steady eddies suddenly look a lot more appealing. This article profiles some of these steady eddies as a safe investment under their beloved brands. Keeping in mind that the S&P was up 8.9% over the last 12 months, let's take a look at how well these companies performed. 8 out of 10 of the steady eddies mentioned in this article did not beat the market's 8.96% gain. 50% of the stocks listed were in the negative, with Avon Products being down 29% since the article was written. So, if these stocks weren't enough BS advice, check out Barron's recommendation to, quote, load up the cart on this stock. What happened to super value stock over the year? You guessed it, down 23.1%. Does stock picking work? You tell me. Hey, maybe if Wall Street research is not going to help us, we should look to the traders, those professionals who know how to time the markets. So let's see where Barron's feels the momentum is going. They highlight Netflix. Barron states these shares just keep going up because they keep blowing earnings estimates out of the water, reminding us that it rose 8% on March 15th when the Dow opened down 265 points. Well, with Netflix being down 48% over the last 12 months, the only thing I'd be wanting to blow up would be that Netflix trade I made after reading that article. In our final report this week, the illusion of track record investing. The stars of the past are going to be winners next year. Here is Putnam's head of the class, the best performing large cap growth manager out of 753 funds for the turbulent 3-year period. Well, unfortunately, if you chose the 2010 head of the class, you would have found out his grades the following 12 months were not that good versus his peers. They were down negative 0.08% since the issue was on the newsstand, underperforming the S&P by over 8%. Okay, well maybe they're just Putnam. I think these fund managers were getting stock picks from the guy upstairs. They give you his direct line, 866, Ave Maria. So how were their picks? 2 out of 3 profiles had significantly underperformed the markets. So that's it for this week's edition of the BS and Barron's Report. These are the 5 industry illusions we'll be reviewing each week to enhance your knowledge in investments. Remember to come back next week, because if you can't see the BS, you're going to continue to step in it.